Poli Sendirian Berhad was a family-owned business. In 1994, four brothers from a Bumiputra family has established a company in Kelang, Selangor to manufacture polythene bags. However, the company then relocated to Alor Gajah, Melaka in 1996. The idea of producing polythene bags for local use was originally proposed by Mr. Rahim. He is the oldest brother who acts as the Chief Executive Officer of Poli Sendirian Berhad. Mr. Rahim is a 49-year-old chemical engineer from Imperial College of London. Poli Sendirian Berhad management consists total of 78 local and foreign employees, including 13 boards of directors and managers. Most of the foreign employees come from Indonesia and Nepal. The remaining employee is Mr. Rahim's three brothers, which is Mr. Yusri, Mr. Zulkifli, and Mr. Nodi. The second brother, Mr. Yusri, was assigned to marketing department and responsible in negotiating and finding potential customers for the business. He graduated from Australian University with a marketing degree. The next brother is Mr. Zulkifli. He is 43 years old and holds a degree in human resource from Uniraza, a local boutique university. Therefore, he was assigned to the Human Resource Department. His roles are to manage all of the employee-related situations. The fourth brother is Mr. Nodi. He had an MBA in Finance major. In the company, his responsibilities are to manage the company finance. Later, the Ministry of Finance awarded Bumiputra status to the company. During the process to complete the production, the company decided to purchase another building about 500 meters away from the original factory, which is Factory 1, and transform it into Factory 2, a place where the company completes the remaining of their production process. Profitability ratio is analysis that are used to measure how effectively a company uses its assets to generate profit relative to its revenue, operating expense, or shareholder equity over time using a data from certain period of time. In the analysis of Poli Sendirian Berhad financial performance, several types of ratio were used, which is net profit margin, gross profit margin, return on asset, and return on equity. This ratio will calculate with the information from income statement and the balance sheet of the company. Based on the study, Poli Sendirian Berhad has encountered several issues such as managing the company cash flow, the increase in minimum wage, the issue of outdated system, and poor inventory management. Firstly is the issue of managing the cash flow. It is important for a company to manage its cash flow properly. If there is a cash flow shortage happening, it indicates that more money is leaving the business rather than coming in. As a result, the company may not be able to pay debt, employee salary, and other operating expenses. In this case, it is found that Mr. Rahim, the Chief Executive Officer, failed to make a proper invoice when making a business agreement with a customer upon purchasing a new machinery. As a result, the company was fully responsible for all obligations when the customer cancelled the order. Secondly, the issue regarding the increase of minimum wage in Poli Sendirian Berhad. The company concerned that the wage increase will drain the profit of the company as the employment cost has increased 10% from before. When the minimum wage increases, employing workers will become more expensive. In order to achieve a lower minimum wage, some employers may choose to lay off some employees. Not to forget the issue of outdated system used in the company. According to the study, Poli Sendirian Berhad has utilized a local software for accounting and other purposes. The semi-automatic software, which was installed in 1996, has never been upgraded for a while. Due to this, a lot of work being delayed, such as income tax. Even the paperwork for supplier and customer were performed manually, and courier were used to prepare and delivery check. Finally, the last issue is the company poor management in inventory. It is important for a company to have a good inventory management in order to avoid both excess and shortage of a product. Many companies do not exercise a proper inventory management, including Polis Sdn Bhd. The graph illustrates the percentage of profitability ratio between the year 2012 and 2011. It can be seen that the number of return on asset fell from 2.05% in 2011 to 0.31% in 2012. Overall, in 2012 and 11 had the higher percentage of gross profit margin. However, in 2012, the number of return on equity decreased almost 8%, which is 8.68% during 2011 and 1.21 on 2012. Also, net profit margin show continuous drop from 2.26 in 2012 and 1.21 in 2012. Also, net profit margin show continuous drop from 2.26 in 2011 to 0.33 in 2012.
My name is Amir Khoy American. Okay, first of all, I would like to present you about definition of leverage ratio. Okay, leverage ratio is any kind of financial ratio that indicates the level of debt incurred by a business entity against several other accounts in its balance sheet, income statement, or cash flow statement. This ratio provides an indication of how a company asset and a business operation are financed using debt or equity. First of all is the debt ratio. In the table, in 2011, the debt ratio is 0.76, but it decreased in 2012, 0.74. That means Polis Sdn Bhd has decreased in asset, but Polis Sdn Bhd has more asset than the loans, which are quite good signal. The next table is debt to equity. Polis Sdn Bhd debt equity ratio was around 3.22 in 2011. However, Polis Sdn Bhd debt to equity ratio has decreased in the next following year, and it is currently at 2.84. In simple terms, it indicates how much a business is dependent on the debt and that has issued, and how the company is using that as a part of financing strategy, and it is dependency on the borrowings. The last one is time to interest. PBIT for 2011 is 1.75 but decreased to 1.12 in 2012. If these ratios score higher, it means the debt is higher than the earning. If this ratio scores lower, the debt is relatively lower than the earnings. And it is a great thing for Polis Sdn Bhd. Next slide is the definition of liquidity ratio. For the liquidity ratio is very crucial part of a business. Liquidity is required for a business to meet its short-term obligation. Liquidity ratios are a measure of ability of a company to pay off its short-term liabilities. And liquidity ratio determines how quickly a company can convert the asset and use them for meeting the dues that arise. The higher the ratio, the easier is the ability to clear the debt and avoid defaulting on payments. And this is a very important criterion that creditors check before offering a short-term loans to the businesses. And an organization which is unable to clear dues result in creating impact on their credit worthiness and also affect the credit rating on the company. First of all, I explain it to you for the current ratio, which is a liquidity ratio measure the company abilities to repay a short-term obligation or any which is due within the year. A bank is considered to have a good current ratio when it is greater than 2.0. It is to indicate if a financial institution will remain solvent in a short term. Okay, policy Berhad has a slight increase to 0.89 in 2012, while previously was at 0.85 respectively. The increase in a year of 2012 isn't drastic. However, this may indicate that they will high risk of default. Next one, I will explain it to you about the quick ratio. From the above calculate data, we analyze that a quick ratio has fallen from 0.6 in 2011 to 0.2 in 2012. It must mean that the current assets are locked up in a stock over time. The ideal standard quick ratio is 1.1. It means that the company is not in a good position to meet it.
Next, let's move on to the comments on listener Berhad. The first one is the financial position. Financial position is the current balance of the recorded assets, liabilities, and equity of an organization. This information is recorded in the balance sheets, which is one of the financial statements. For example, the corporation would list down the common stock, preferred stocks, additional paid-in capital, treasury stocks, and retained earnings. Meanwhile, a partnership would simply list the members' capital account balance, including the current earnings, contributions, and distributions. Based on the information given, both instruments is listed out their assets, liabilities, and equity perfectly. Second one is the gearing and leveraging issues. Based on the ratio analysis, the times interest at a decreasing ratio. Besides that, there is a decrease in the debt ratio by 2 from 2011 to 2012. This is due to the decrease in the total assets and liabilities. However, as the ratio is less than 1, it indicates that there is more assets compared to debts. A higher gearing ratio indicates that a company has a higher degree of financial leverage and is more susceptible to downturns in the company and the business cycles. This is because companies that have a higher leverage have higher amounts of debt to shareholders' equity. Entities with a higher gearing ratio have higher amounts of debt to service, while companies with a lower gearing ratio calculations have more equity to rely on for the financial. The third one is liquidity issue. Current ratio, which is a liquidity ratio, measures the company's ability to repay their short-term obligations or any which is due within a year. A bank is considered to have a good current ratio when it is greater than 1. This is to indicate if a financial institution would remain solvent in the short term. Policy student Berhad has a slight decrease from 0.62% in year 2012, while previously it was 0.64% respectively. The decrease in the year 2012 isn't drastic, however, this may indicate that there will be a higher risk of default. Based on the calculation above, Both year has a better current ratio standing has increased from 0.85% to 0.89%. Last but not least is interest coverage issue. The interest coverage issue measures a bank's ability to pay its debt obligations interest. A low ratio would indicate that the company is running into financial trouble. These ratios are often investigated by investors and creditors. Thus, the higher the ratio, the better it is for the company, as they have sufficient earnings to repay their interest on debt obligations. Over the years, 2012 has the lowest ratio amongst these years. But as the ratios are more than 1, being 1.75 at 2011 and 1.12 at 2012, respectively, it is safe to say that they are still able to repay their interest on debt obligations. However, this also indicates that in 2012 can repay the creditors and investors 2 times over than the interest expense owed by the year. In conclusion, financial analysis is the process of evaluating the performance and suitability of the company's projects, budgets, and other financial related transactions. Financial analysis is frequently used to determine whether a company is stable, solvent, liquid, or profitable enough to justify a financial investment. By comparing a company's performance throughout the year, it will be able to show how well the business is doing over the time. Financial ratios has been acknowledged on their capabilities in helping management to evaluate companies' financial performance. Financial ratios can also be the best reference in explaining what has happened in the past and can help the management and financial analysts to understand business trends. While some trends can act as indicators of a company's potential future, this ratio is still unable to provide a realistic forecast for the business. Based on the company financial analysis above, both financial statements on 2011 and 2012 shows that the company are not doing well in their business. In order to overcome this situation, the company need to organize and monitor their management properly, which is make a new marketing strategy to generate more profit, managing the cash flow carefully, updating the newer system, and many more.